Welcome to The Explainer. Today, we are tackling a big one, India's rules for sending and receiving money internationally. How much can you actually send abroad? And what happens when you get money from another country? Is it going to cause a headache with the bank or with your taxes? Let's get right into it.
Okay, so when you boil it all down, it's really just about two things, right? Money going out of India and money coming in. Sounds simple enough, but, and this is the key, the rules for each are completely different. And that's pretty much where all the confusion kicks in.
So that leads us to the million-dollar question. Well, maybe the $250,000 question in this case. What are the real limits? How do you make sure you're playing by the rules so your bank doesn't suddenly block a really important transfer? All right, let's break it all down. Okay, first up, sending money from India to another country. Now, this whole process, every bit of it, is managed by the Reserve Bank of India. They've set up a very specific framework to keep tabs on it. And that framework has a name. It's called the Liberalized Remittance Scheme, or as you'll always hear it, LRS. Its main job, really, is to set one super important, crystal clear limit for every single person. And here it is. This is the magic number you have to burn into your memory. 250,000 US dollars. That's it. That's the absolute max an Indian resident can send out of the country in one financial year. Now, it's really, really important to get what this number actually means. This isn't $250,000 per transfer. Nope. It's per person for the entire financial year, so from April to March. And get this, it's the total combined amount across all of your bank accounts, so you can't just open another account to get around it. Oh, and a question we get all the time. What about joint accounts? Well, that limit applies to each person individually, so 2 account holders means 2 separate limits. So what can you use this money for? Well, pretty much all the big, legitimate reasons you can think of. We're talking about paying for your kids' education abroad, covering medical treatments, international travel, even investing in foreign stocks or buying property overseas. When you go to make that transfer, your bank is just going to ask for a purpose code, basically to make sure it's all above board. All right, let's talk about the thing that probably gives people the biggest heart attack. That 20% that suddenly gets sliced off your transfer. What is that? Well, it's called tax collected at source, or TCS, and honestly, it's probably the most misunderstood part of this whole process.
Yeah, this really hits the nail on the head. The biggest myth is that this is some new extra tax that the government just takes and you never see again. That is absolutely not true. Think of it more like an advance payment. It's a chunk of the income tax you were probably going to pay anyway, just collected up front.
So here's the bottom line, and this is what you have to remember. TCS is not an extra tax. It is recoverable. Any amount they deduct can either be claimed back as a refund when you file your taxes, or you can use it to offset the final tax you owe. You do not lose that money. Okay, so we've covered sending money out. Now, let's flip the coin and talk about what happens when money is coming into India. Maybe you've got family abroad sending you money, or you're getting paid for some work you did. The story here is completely different. And right off the bat, here's the best news you're going to hear today. There is generally no upper limit on how much money you can receive from another country. That's right. Unlike the strict LRS limit for sending money out, you can receive large sums without worrying about hitting some central bank cap. But, and this is a big but, it doesn't mean it's a complete free-for-all. Your bank has a legal duty to make sure everything is legit. So if a large amount of money suddenly appears in your account, you can bet they're going to ask some questions. You should be prepared to show documents that prove where the money came from and, what your relationship is to the sender. And this is another really key distinction. The act of transferring the money itself isn't taxed, but the reason you're getting the money, well, that might be. For instance, if you're a resident and that money is your salary from a foreign company, yep, that's taxable income. But if it's a gift from a close relative, like your parents or a sibling, that's generally tax-free. So it's all about the nature of the income. Okay, so we've looked at both sides of the coin. How do you actually put all this into practice and make sure your transfers, both in and out, go smoothly, without setting off any alarm bells with the tax authorities?
What the system is really looking for are things that just don't add up. Think about it. If your declared income for the year is, say, 6 lakh rupees, but you try to send 1 crore abroad, that's a huge red flag, right? It's all about consistency. Even something like accidentally going over your LRS limit without getting special permission from the RBI can trigger a review. They just want to see that what you're doing financially matches what you're telling them.
So here is your simple 3-step playbook to stay compliant and stress-free. Step 1. Document everything. Always, always keep proof of where the money came from and what it's for. Step 2. Be consistent. Make sure the money you're moving makes sense with the income you've declared. And Step 3. File your taxes properly. Declare everything correctly in your annual ITR filing. This is also, by the way, exactly how you claim back any of that extra TCS they might have collected.
All right, let's pull all of this together for one final, super clear takeaway.
And here you go, pretty much the entire explainer on one single slide. When you're sending money out, you're thinking about that $250,000 yearly limit and the purpose of the funds. When you're receiving money, there's no limit, but you have to be ready to show the source, and you need to understand how the type of income will affect your taxes. Simple as that. You know, when you really get a handle on these rules, international money transfers stop being this scary, stressful thing. They become a really powerful financial tool that you can use legally and effectively. The whole key isn't to try and avoid the rules, it's just to structure things the right way. So the only question left is, are your global transfers compliant, clear, and most importantly, confident?